Hello and welcome to Chapter 19, Cost Volume Profit Analysis. In this chapter, we're going to be discussing cost behaviors. We're also going to be discussing this wonderful thing called break-even. Break-even is a very important concept to understand in business because we need to know at what point do we start making a profit. Profit's the whole reason why we're in business. So let's talk about it. There's cost behaviors. Cost behaviors manner in which the cost changes as it relates to activity changes. Very simple. The way I want you to think about this is the more output we have, output meaning finished goods, the more finished goods we have, the more that we sell those finished goods, the more profit we take in, right? The more revenue we take in. The more our level of output changes, which is an activity base, the more our activity base changes, the more our costs change. Okay? Higher output, higher cost. Lower output, lower cost. As things change, as our activity levels change, the more our costs will change. So within that, we have this activity base, which we talked about in our activity-based costing chapter. I think that was about 2 chapters ago. We also have this thing called relevant range. Relevant range is think of it like a short range, like 5 through 7, 5 through 8. This is a relevant range, okay? It means what the more levels of output within that range, the more relevant it is. Okay. We'll talk more about that. Variable costs. We know what variable costs are. We've been talking about this for a long time now, several chapters. Variable costs are costs that vary in proportion to the change in the activity base. Okay, variable costs are direct materials and direct labor. Those are variable costs. The reason why they're variable costs is because they vary with the input and output. Okay, the more outputs I have, meaning the more finished goods, that means I must have had more direct materials and more direct labor. And the opposite is also true. The less my output is, the less direct materials and direct labor I have. So it's very simple. Just think of it as the more output I have, the more direct material costs I'm going to have. The more output I have, the more cost and labor I'm going to have, right? It's very simple. So here's an example. This company, they manufacture stereo systems. Their cost of direct materials is $10 per unit. They have a relevant range of 5,000 units to 30,000 units of production. Okay. Remember, relevant range. 5,000 units to 30,000 units. In other words, they can produce anywhere between here in a certain amount of time, right? Notice this. The direct materials cost per unit, it never changes. It does not change based off of the numbers I produce. It's still going to be $10 a unit. It doesn't matter whether I produce 5,000 units or 30,000 units. It's still $10 per unit, okay? So in order to get our direct materials cost, it's very simple. We take the number of units we produced times the cost per unit to equal the total direct materials cost. Very simple, very straightforward. But we can see here 2 things. Number 1, the cost per unit does not change regardless of the change in activity base. Activity base, right? And number 2, the cost changes in proportion to the changes in activity base. In other words, the more units I produce, the more my total direct materials cost is. The more numbers I produce, the more my total direct materials cost is. To find total direct materials cost, I just take the number I produced times my cost per unit to get my total direct materials cost. And we can see that relationship here. Here's how it looks graphically. We can see that the more units I produce, the higher my direct materials cost is. That's what this relationship shows. The more units I produce, the higher my total direct materials cost is. We can also see that regardless of how many units I produce, the cost per unit remains the same. And that's what the second graph shows. So it just kind of shows it graphically, right? A couple of examples. Different types of businesses, their cost driver and their activity base. We know that based on the activity, the higher the cost is. For example, passenger airline. The number of miles flown is the activity base. Clearly, the more miles I fly, the higher my total fuel cost will be. Although the cost per gallon of fuel may be the same. So if I paid $2 per cost of gallon, and I fly 3,000 miles, I know that I'm going to have, $6,000 worth of fuel cost. If I fly, it's still $2 per gallon, and I fly a longer distance. Let's say I fly 10,000 miles. Then I know my total fuel cost is $20,000. So you see the relationship. Okay, so what about fixed costs? We know that there's fixed costs involved here. Fixed costs are the costs that remain the same regardless of the changes in activity base. This is typically factory overhead. Factory overhead costs are typically fixed. What do we mean by that? We know that the cost of depreciation for the machines is going to be the same. We know that, assuming that's straight line, we know that the rent is going to be the same. The rent doesn't matter. The rent doesn't care whether you produce 3,000 units or 10,000 units. The rent still has to be paid. The rent is a fixed cost. And then there's salaries. The manager's salary, it doesn't matter how many units you produced. The manager's salary is still the same. That's a fixed cost. So let's look at it from a manager's salary perspective. And here's an example of a company that manufactures perfume or cologne, whichever you prefer. So this manager, her name is Jane. Her annual salary is $75,000. She oversees this company. They produce perfume. Their relevant range is 50,000 units to 300,000 units. Her salary is $75,000. It's fixed. It doesn't change, regardless of how many bottles the company produces. But here's the interesting thing. As you know, with activity-based costing, I can allocate Jane's salary to each bottle produced. Okay? Her salary's still the same. She's still going to get paid the $75,000. But the cost per bottle will be a little bit different because I'm taking her salary and I'm allocating it to each bottle produced. So let's look at it from this example. We produced 50,000 bottles. Jane's salary is $75,000. That means it's $1.50 per bottle of Jane's salary that I can allocate to each bottle produced. But if I produce 300,000 bottles in that year, Jane's salary is still $75,000. I can allocate 25 cents to each bottle produced. Now, how do we do this? We simply take the number of units produced and we divide by the salary to equal the salary per bottle. So 50,000 divided by 75,000 is 1.5. 300,000 divided by 75,000 is 0.25, so forth and so on. But we realize that the cost per unit decreases, the cost per unit decreases based on the increase of units of activity. What the freak? My fire alarm's randomly going off. I will be right back. Hold on just a sec. Okay, apologize for the brief break. So as we can see with fixed costs, the cost per unit decreases as the amount that we produce increases. And we also notice that the fixed cost, in this case the salary, remains the same regardless of the change in activity. Here's how it looks graphically. Now again, we know that the salary remains the same regardless of the number of units produced. However, the cost per unit reduces as the number of units produced increases. Okay, so looking at my airline example again, based off of the number of miles flown, my cost of depreciation will increase based off of the miles flown. However, the amount remains the same each year based on straight line depreciation. Okay. Now, here's a new term. Well, relatively new. You probably heard it once before, but let's do a bit more of a deep dive. Mixed cost. You heard about fixed costs. You heard about variable costs, but now we have mixed costs. Mixed costs. These are costs that have the characteristics of both fixed and variable costs. Mixed costs are sometimes called semi-variable or semi-fixed. Mixed costs. Now, just keep in mind they are both variable and fixed costs together. Here's an example. Rent. In most cases, rent is a fixed cost. The rent does not change year to year. However, there are some situations where the rent might change every single month. And I'll give you an example. When I was working in retail many years ago, our rent for our location in the mall changed every single month. Why is that, you might be asking? The way that the rent works for a store and a shopping mall is they pay a base price for rent, plus they have to pay a percentage of their gross sales. Yes, I know. Some of you are like, wow, I had no idea. Yeah, that's true. So they pay a base rent plus a percentage of gross sales. It's usually like 2-3%, depending on which mall, which area, all that stuff. But yeah, and sometimes that can be negotiated, but that's the reality. That's the way retail works in shopping malls. They pay base rent plus 2-3% of gross sales. Now, the example I'm about to show you is from a manufacturer perspective, where apparently their landlord also charges a similar way, right? So looking at this example, we have a base rent of $15,000 per year plus $1 for each hour used in excess of 10,000 hours. Now this is rental for, looks like a machine. You know, they're renting a machine. And you've seen this before, right? So like, let's say you rent a U-Haul truck if you're moving, right? You rent the U-Haul truck, they'll say, oh, great, you know, it's $20 base rent plus $1 for every mile or something like that. It's the same concept. So here's how that's formulated. The rental charges varies based off of the hours used. Now, looking at this range, for 8,000 hours, it's 15,000. You're like, yeah, but Dr. B, it says 10,000 hours. $1 additional in excess of 10,000 hours. So base rent, still 15,000. So if we use the machine for 8,000 hours, it's still 15,000. If it's 12,000 hours, it's the base of 15,000 plus the additional 2,000 hours times $1 per hour, so that's an additional $2,000. So 12,000 minus 10, that's 2,000 times $1, that's $2,000. So that gets us to a total rent charge of $17,000 for 12,000 hours used. 20,000 hours used is 25,000. How we got there? The base of 15,000 plus the additional 5,000 hours times $1, that's 5,000. So that gets us up to 25,000. So 15 plus, well, actually, wait a second. Oh, I'm sorry, 20 hours, 20,000. For some reason, I thought it was 15. It's 10,000 hours. My bad, sorry about that. So 10,000 hours times $1, that's 10,000. 10,000 plus 15,000 is 25,000. And for 40,000 hours, $15,000 base plus the hours minus the base hours, that's 30,000 times $1. So 30,000 plus the 15, that's 45,000. Everyone sees how that works? That's why we call it mixed cost.
You did within the parentheses, and then you went back. You showed us plus the 15 to give us the 45.
Yeah, exactly. Yeah, it's order up.
You minus the 40 hours minus the 10, that's to give you 30, like you said. And if you was the times that one that give you 15,000, you add that to it, that makes it 45,000.
You got it. Yep, exactly right. And that's what makes it a mixed cost. The fixed part is the 15,000 a year. That's fixed. It doesn't matter, you know, if you used it, how many hours you used it, it's still fixed, right? So the fixed cost is the 15,000 per year. The variable cost is that additional $1 per hour in excess of 10,000. That's why we call it a mixed cost. It's fixed and variable cost together. Okay, so here's how it looks graphically. So we see that it's flat 15,000 until it reaches 10,000 hours, and then it's an additional $1 per hour thereafter. So if you did it graphically, we could easily identify, you know, how much the total cost is, right? So, 15, it looks like here is 20,000 because 15,000 hours. And you could just identify that, right? So that's the nice thing about the graphs. They're kind of a pain to make, but they're easy to use. Okay, so continuing the theme of mixed costs, to estimate our costs, you know, because we got to estimate things. Why do we estimate things? If you think about it from a budget perspective, you need to have an idea of how much we're going to be spending for that year. So the same concept applies with a mixed cost. We know we could budget for fixed costs. We know we have an idea of how we can budget for variable costs, but what about mixed costs? When we budget for mixed costs, we use this thing called a high-low method. It's where we look at the low and the high, and we kind of figure out what the cost will be between the two. So it's an estimation method that may be used to separate mixed costs into their fixed and variable components. High-low. Okay. So here's a company equipment maintenance department incurred the following over the past 5 months. June, July, August, September, October. Month of June, they produced 1,000 units, 1,500 units July, 2,100 units August, 1,800 units September, 750 October. We can see that their total cost is very closely correlated. 45,500 June, 52,000 July, 61,005 August, so forth and so on, right? The number of units produced is the activity base, relevant range of the units produced between the months of June and October. So how do we do the high-low method? Well, the way it works is we take the highest level of production and the lowest level of production and identify the difference. Okay, at the highest level, we produce 2,100 units for a total cost of 61,500, right? 2,100 units, 61,500 in the month of August. Our low was in the month of October. 750 units produced, $41,250 total cost. Then we figure out the difference. To figure out the difference, we just take the high minus the low. High minus the low gives us our difference. So that's this first step. That's the first step, yeah? So you figure out your differences for both units produced and total cost. So step one, you take your high minus your low to get your difference for unit produced, and then you take your high minus your low to get your difference for total cost. That's step one. Step two, we figure out our variable cost per unit. So we take, to figure out the variable cost per unit, we take the difference in total cost divided by the difference in the units produced. So in this example, we take our 20,250 divided by 1,350 to get a total variable cost per unit of $15 per unit. Questions so far? Are we okay?
Okay.
Okay, wonderful. Thank you. Okay.
This is what I figured out. This is what I was telling you on chapter 20, when I had read and I had understood what the question was asking by me by reading it, and then I was able to pick up and do the math problem with no problem by me reading the book, and like you said, following through the steps, and that's what helped me also not have to go back to the book to figure it out, because when you read the book, it shows you the examples. Then when you go and take the homework, you can remember what you had already did by memorizing. Like you said, it's the concepts. What is it asking you? My thing I had a problem with was reading the word problem. What was it asking me? And I had to figure out the wording, the concepts, and figure out what is this problem asking me, and make sure that I'm doing the right thing and not the wrong thing. And that's all I wanted to say.
Yeah, great. Yeah, I appreciate you sharing that. So for the rest of you, definitely take note because this will certainly help with that homework. So the fixed cost is estimated by subtracting the variable cost from the total cost. Makes sense, right? So that's how you would find fixed costs, is you take your total cost minus your variable cost. Simple. So, but the thing is, you need to know what your variable costs are. So to figure out your variable costs, take your variable cost per unit times the units produced. That makes sense. So let's figure out fixed costs. We take our total cost, and we do it for both the high and the low. Because remember, we need to solve for the high-low method. So when we figure out our fixed costs, we're figuring out our fixed costs at both the high method, the high level, and the low level. So we said earlier that at our high level, we produced 2,100 units. I think it was August, right? So 2,100 units was produced in the month of August. We already identified what the variable cost per unit is. It's $15. So we take our $15, or first we take our total cost. Our total cost is $61,500 minus, first you do this part, right? You take your variable cost per unit times 2,100 units to get to 31,500. So you take your total cost of 61,500 minus 31,500 to get a total fixed cost at the high level of $30,000. Now let's do it for the low level. We take our total cost minus the variable cost per unit times the units produced. At the low level, we said we produced 750 units. So first thing you do, order of operations, $15 times 750 units gets you to $11,250. At the low end, our total costs were $41,250. $41,250 minus $11,250 equals $30,000. Wait a second. Oh, how interesting. It is the same amount as the high level. Yeah, so this is how you find fixed costs, because as we said earlier, fixed cost does not change regardless of the level of output. So in order to find what our true fixed cost is, we perform at both the high and the low. And once we realize that the two are the same, that's when we know that's our true fixed cost. Good so far? Sometimes that part's a little tricky. Great, thank you. Okay. So using the variable cost per unit and the fixed cost, the total equipment maintenance cost for the company can be computed for the various levels of production by looking at the following. We have our total cost. What is total cost? Well, we know that total cost is variable cost plus fixed cost. Our variable cost is $15 per unit times the number of units produced, plus our fixed cost. Fixed cost we determine is $30,000. So let's say the company produces 2,000 units. So what we do is I don't know what's going on there. We take the $15 per unit times the 2,000 units plus 30,000. That's 30,000 plus 30,000. You got to say total cost of 60,000. Nice and straightforward. It's just a matter of really kind of remembering the formula, right? And then it's just you're plugging in the values that are given. But remember the steps. The steps are probably the most important. Got to remember the steps. It's doing it again. Come on. What is going on here? Oh, away. Oh, that's not what I wanted to do. Said that darn WebEx. Okay. Let's summarize some of the concepts. One method of variable and fixed cost is called variable costing or direct costing. This is the terminology, right? This describes what the reporting of variable and fixed cost is. We call it variable costing or direct costing. Actually, it's mostly called direct costing. Under variable costing, only the variable manufacturing costs, which include direct materials, direct labor, and variable factory overhead, are included in the production cost or the product cost. The fixed factory overhead rate is treated as an expense. Okay. The effect on the change. We have two types of costs, variable cost and fixed cost. Well, we also have mixed costs, but you know what those are already. The effect is on the total amount and the per unit amount. The variable cost per unit amount remains the same regardless of activity. The per unit amount changes. The fixed cost increases or decreases based on the activity level. We learned about that a few slides ago when we talked about the manager's salary, the perfume factory. With respect to the total amount, increase and decrease proportionally with the activity level. And for fixed, it remains the same regardless of activity level. So it's kind of the inverse, right? These are just examples of fixed costs, variable costs, and mixed costs. Cost, volume, profit analysis. So this is more of the same concept, but we're going to take what we just learned and we're going to apply it to understand what is our break even. What is our break even? So cost, volume, profit analysis is the examination of the relationships among the selling price, the sales price, production volume, costs, expenses, and profits. We examine all of these things in order to understand the point of break even. Some ways of cost, volume, profit analysis may be used includes analyzing the effect change on selling price, analyzing the change in cost on profits, looking at the change in the volume on profits, setting selling prices, selecting the mix of products to sell, and choosing among marketing strategies. To figure a lot of this stuff out, I look at this very important formula. I really like this formula. This is one of my favorite formulas. It's called the contribution margin. The contribution margin is the excess of sales over variable costs. And it's very simple. You take your total sales minus your variable costs. The contribution margin covers all of your fixed costs. At least it should anyway. Most of the time it does. Once the fixed costs are covered, any additional contribution margin increases income from the operations. So let's run it in an example. This company has the following data. Sales, we sold 50,000 units at a selling price per unit of $20 per unit. The variable costs are $12 per unit. The fixed costs are $300,000. Okay, so on the income statement, you have your sales. You have your sales minus your variable costs, also known as your cost of goods sold, equals your contribution margin, also known as gross profit. Gross profit minus your fixed costs equals your net income from operations. So $1 million in sales minus variable costs of $600,000 gives us a contribution margin of $400,000. Minus our fixed cost of $300,000 gives us a net income from operations of $100,000. Everyone sees how we got there? Yes? So remember, contribution margin, number of units sold times the net, right? So the way you figure out what is this $8, right? What is this? In other words, a way to figure out your contribution margin, you take your sales price per unit minus your variable cost per unit. Sale price per unit minus variable cost per unit gets you your net per unit. Net per unit. $8. That's your contribution
That's
margin.
how you got the $8. Yep, you subtract the 20 from the 12,
You
will give
got it.
you 8. Okay, okay.
Absolutely. And that's
So
how you
that's
figure
how
out
you got the. So that's how you know what to what will be your what will you then multiply what it by
you.
once you do the subtraction.
Yep. Well, after you do the subtraction, so your sales price per unit, $20 minus your variable cost per unit, $12 gives you $8 per unit. The $8 per unit, we call that your contribution margin per unit. Contribution margin per unit is $8. You multiply that by the number of units sold. You multiply your contribution margin per unit times the number of units sold. And that gets you to your total contribution margin. Good question. So yeah, that's a fun example. I like that one. That's one of my favorite ratios. Here's another one. There's another good one. So it's like, okay, so this last one we did, the contribution margin ratio, we were able to figure it out from, contribution margin, we figured it out from a dollar perspective. Now, let's look at it from a percentage perspective. Percentage perspective, by looking at the contribution margin ratio. This is also known as the profit volume ratio, indicates the percentage of each sales dollar available to cover the fixed costs and to provide income from operations. Here's how it works. You take your contribution margin divided by your total sales. In our earlier example, our contribution margin is $400,000. Contribution margin is $400,000. How we got the contribution margin? Again, we took our total number of units sold times our contribution per unit, which is $8. So 400,000 divided by total sales. We said total sales was 1 million. 400,000 divided by 1 million is 40%, or 0.4. Once you know it's 0.4, you just multiply by 100, right, to get the percentage, 40%. Okay. The contribution margin ratio is very useful for when the increase or decrease in sales volume is measured in sales dollars. In this case, the change in sales dollars multiplied by the contribution margin ratio equals the change in income from operations. So how do we figure out change from income in operations? We take the change in sales dollars times the contribution margin ratio. Change in sales dollars. When you hear the word change, we're usually subtracting, right? So for example, if this, or adding, depending on what the change is. If the company adds an additional $80,000 in sales from selling an additional 4,000 units, its income from operations will increase by $32,000. Well, how do we figure that out, right? So if we increase if we sell an additional $80,000, so you take $80,000, that's your change in sales dollars. We multiply that by our contribution margin ratio, which is, we said earlier, was 40%. So 80,000 times 40% equals $32,000. That's our change in income from operations. Okay, so how do we confirm all of this? Here's what the changes look like, right? So we originally sold $1 million. We then sold an additional $80,000. So that means we sold an additional 4,000 units. So now 54,000 units times a selling price of $20 per unit. That gives us our sales. Variable cost, 54,000 units times $12, $640,000. That's the updated variable cost per unit. The updated contribution margin. We sold 54,000 units times $8. It's an updated contribution margin of $432,000. our fixed costs are still 300,000. Remember, fixed costs don't change regardless of the units of output. So you take your 432,000 minus your fixed costs of 300,000 to get to $132,000 of income from operations. Okay, we looked at contribution from just a simple contribution margin. We looked at contribution margin from a ratio. Now let's look at unit contribution margin. This again is our contribution margin per unit. And we know how to calculate this. We've already done it. This is where you take your sales price per unit minus your variable cost per unit to get to a unit contribution margin. Unit contribution margin. So sales price was $20. Variable cost was $12. To get us to $8 per unit in contribution margin. Oh, sorry. I went too fast. The unit contribution margin is very useful when the increase or decrease in sales volume is it's measured in sales units. In this case, the change in sales volume, which again, the word volume means units. The word volume means units. It's multiplied by the unit contribution margin and is equal to the change in the income from operations. So what we do here is we take the change in sales units times the contribution margin. The company sold an additional 15,000 units, up from 50,000, gives us a new total selling units of 65,000. We take our change. Our change is 15,000 units times our unit contribution margin of $8 per unit, gets us a change in income from operations of 120,000. Here's how it looks updated. Sales, 65,000 units times 20 bucks per unit, 1.3 million. Variable cost, 65,000 units times $12, 780,000. Contribution margin, 65,000 units, $8. 520,000. 520,000 minus fixed costs of 300,000 equals income from operations, 220,000. Okay, more fun stuff. I like this one. I like this formula. I like most of them, but these are important to know. The reason why they're important to know is because you need to be able to cover your operating costs. Cover your operating costs. That includes covering your fixed costs and your variable costs. This is how we know when the company is generating a profit, is when you're covering your costs. So here we go. The break-even point. The break-even point level of operations is what the company's revenues and expenses are equal. I brought in enough revenue to cover all of my expenses. That's break-even. That's break-even. I didn't make a profit, but I also didn't lose any money. That's break-even. To calculate break-even, we can do it in both sales dollars and we can do it in units that we need to sell, right? So the way we do that is we take, to figure out in units we need to sell, we take our fixed costs, total fixed costs, in our earlier examples, 300,000, divided by our unit contribution margin, 8,000.
Professor, I have a question.
Yes, Samaya.
So when you do fixed costs, is that like an average of what it would cost to make each individual item?
No, the fixed cost is fixed cost. So an example would be salary, rent. Those are fixed costs. So those wouldn't be average. What you're thinking about is variable cost. Variable cost would be more average. Does that help to answer your question?
Yes, sir. Thank you.
You're welcome. So fixed costs in our example is 300,000. Our unit contribution margin is $8. The word break even, again, it means that our revenues equal our costs. Revenue equal our costs. We're not making any profit, but we're also not losing any money. Break even. Okay, here's a new example. Let's assume that this company has a total fixed cost of $90,000. It could be like salaries plus rent, that type of stuff, fixed costs. And then we have a unit selling price. We're selling our whatever product this is at $25 a piece. Our variable cost per unit is $15, which means our unit contribution margin is 10. We take our selling price minus our variable cost to get to unit contribution margin. Selling minus variable equals unit contribution margin. In this case, it's $10. So to figure out how many units do we need to sell to break even? By breaking even, it means we're covering our fixed costs, right? So we take our fixed costs, in this case $90,000, divide that by 10. 10 is our unit contribution margin, equals 9,000 units. This means we need to sell 9,000 units in order to break even. Okay, let's take a look at our income statement. I need to sell 9,000 units to break even. So if I sell 9,000 units at a sales price of $25 per unit, that gives me $225,000 in revenue. I have variable costs. 9,000 units I'm selling times $15 per unit of variable cost equals $135,000. We take our, go ahead, Lakeisha.
Oh no, I was about to go ahead. I was about to finish it off. Once you take the 135, they give you the 90,000 in your fixed cost. You bring that down, that'll be 90,000. Income from operations would then be 0. So basically what they did was, what all you're doing is taking your 9,000 times your 25 will give you the 225.
Right.
Then you would subtract, then you would take your variable cost, 9,000 units times your 15. Remember, we subtracting those units, remember the sales and the verbal. So
Yep,
we're
sales minus
subtracting that,
variable costs,
yes, from each
equals
other.
contribution margin.
Right. Each of contribution. So I'm getting it. I just
Yep.
wanted to make sure.
Yep. No, you're good. Yep, exactly. So sales minus variable costs equals contribution margin. If your contribution margin is the exact same as your fixed costs, you have broken even. Right? That's the idea behind break even, is that we're covering all of our fixed costs. So when your contribution margin is the same as your fixed costs, you broke even. That means your income from operations is 0. When it's 0, that means you broke even. So we looked at it from in terms of number of units. Now let's look at break even from sales dollars. Now we know how many units we got to sell, but how many dollars do we need to sell it for in order to break even? To figure this out, we take our total fixed costs divided by our contribution margin ratio. The contribution margin ratio can be computed by taking your unit contribution margin divided by your unit selling price. Okay. Contribution margin ratio is we take our unit contribution margin divided by unit selling price. So here we go. From our earlier example, unit contribution margin is $10. Our selling price is $25. That means our unit contribution margin ratio is 40%. We take our fixed costs, 90,000, divided by 40%. I need to sell $225,000 worth of product to break even. Everyone sees how we got there? Fixed cost divided by contribution margin ratio equals break even in sales dollars.
Yep.
All right, cool. Okay, real quick, affecting changes on fixed costs. When fixed costs change, we need to then obviously adjust our break-even point. Fixed costs, once in a while, they change. We gave somebody a raise. Our cost of rent went up. Our property taxes went up. Our other expenses went up, which means our fixed costs go up, right? Fixed costs can go up or down, mostly up. Changes in fixed costs will obviously affect the break-even point. If my fixed costs rise, that means I got to sell more to cover my break-even. The opposite is also true. If my fixed costs decrease, that means my break-even point is lower. Remember, they follow the same relationship. Fixed costs go up, that means my break-even goes up. Fixed costs go down, that means my break-even goes down. So let's assume I have a change in advertising. Our advertising price went up. Okay. So here's the assumption. Our current selling price is $90. Our variable cost is $70. Our contribution margin is $20. My fixed costs, they're currently at $600,000. If I engage in this additional advertising expense, my current cost will go from $600,000 to $700,000, which means my break-even point will change. My current break-even, $600,000 divided by the unit contribution margin of 20, means I need to sell 30,000 units. If I engage in the new advertising, my fixed costs go up to 700,000. My unit contribution margin stays the same. The difference here is that I need to sell more in order to cover the additional cost. So 700,000 divided by $20 equals 35,000 units I need to sell. That's an additional 5,000 units I need to sell in order to cover that additional $100,000 in fixed cost. Now, sometimes our unit variable costs will change. And this comes from a change in direct materials price, a change in the hourly wage rate, those types of things. Because as you know, direct materials and direct labor equal the variable cost. If I have a change in direct materials or direct labor or both, this will clearly also have a change on my break-even point. And it follows the same relationship. If unit variable costs increase, that means my break-even point increases. Opposite is also true. So let's look at it from this example. Let's say I have a 2% increase in wages. My wages, obviously, that's a part of variable cost. Direct materials, direct labor. Direct materials and direct labor equal variable cost. If I have an increase in direct labor by 2%, that means I have an increase in my variable cost by 2%. So, my current selling price, $250 per unit. My unit variable cost, currently $145. My contribution margin is $105. My fixed costs are $840,000. I have a new variable cost. I take my current variable cost plus the 2% increase. To figure out the 2% increase, I take my selling price times 2%. Selling price per unit times 2%. So whatever that is, plus my original 145, equals now the new price $150. So $250 times 2%, that's $5. So $145 plus $5 is $150. My new unit variable cost is $150, which means my new unit contribution margin is $100. And of course, our fixed costs remain the same. Good so far, right? Yeah? Okay. So given the increase in 2% in labor, fixed costs remain the same, $840,000. Divided by my old contribution margin, 105, equals 8,000 units I need to sell to break even. Now I have an increase in increase in labor, cost of labor. My fixed cost, 840,000, divided by my new unit contribution margin of $100, equals, I need to sell 8,400 units to break even. Good? Yes? Okay. And of course, these changes, as these changes take effect in unit selling price, let's look at a change from unit selling price. If I raise my price, my selling price, okay, how much I sell it for? If I raise that, let's say instead of selling it for $25, I now sell it for $30. I increase my sales price. That means I need to sell less to break even. My selling price is different from my cost, remember? My sales price. If I increase my sales price from $25 to $30 per unit, that means I need to sell less in order to break even. But if I decrease my sales price, I need to sell more to break even. Increase in selling price, break even goes down. Decrease in selling price, break even goes up. Inverse relationship. Okay. Right now I sell this product at $50. My variable cost is $30. My current contribution margin is $20. My fixed cost is $600,000. I want to increase my sales price by $10. So if I take it from 50 up to 60, my variable cost is still 30. My unit contribution margin is now 30 per unit. My fixed costs are $600,000. So give them the change, okay? Here we go. $600,000 fixed cost divided by unit contribution, the old unit contribution margin of 20 means I need to sell 30,000 units. But here's the cool thing. Let's say I increase my sales price by 10 bucks. That gives me an increase my unit contribution margin by $10. Fixed cost, $600,000 divided by the new unit contribution of $30. This means I only need to sell 20,000 units to break even. That's fun. I like it. This is just a summary of the types of changes. Fixed costs rise. That means break even rises. Opposite is also true. Increase in unit variable costs as they rise. Break even rises. The only part where it changes, where there's an inverse relationship, is in selling price. Selling price rises, break even decreases. Selling price decreases, break even rises. Now, some businesses, they establish what's called a target profit. This is the amount I want in profit. I really want it. I really want to make $1 million in profit. Oh, that'd be nice. It'll never happen, but it'll be nice. Okay, so I really want it. So some companies will establish a target profit. So the target or desired amount of profit is determined by modifying the break even. That makes sense. So to do that, we take our fixed cost plus our target profit divided by the unit contribution margin. Our fixed costs in this example are 200,000. Our target profit's 100,000. Okay, that's a nice profit, 100,000. That's nice. Unit selling price is 75. Variable cost is per unit is 45. That gives us a contribution margin of 30. Remember, selling price minus variable equals contribution. In order to figure out how many units I need to sell to make $100,000 in profit, this is how we compute it. I take my fixed cost, 200,000. I want to make 100,000 in profit, so that's 300,000. Divided by contribution margin per unit of 30 tells me I need to sell 10,000 units in order to make $100,000 in profit. Does it make sense? Yeah? I hope so. Here's how it looks on the income statement. Sales. I need to sell 10,000 units in order to make $100,000 profit. I sell 10,000 units at $75 per unit. That's $750,000. My variable cost is $45 per unit. That's $450,000. My contribution margin is $300,000. Sales minus variable costs equals $300,000. The other way to figure that out is you just take your number of units sold times the contribution margin per unit, $30, is also $300,000, minus your fixed cost, $200,000, means you've achieved your target profit of $100,000. Income from operations, $100,000. So as we just saw on the income statement, our sales of $750,000 is necessary to earn a target profit of $100,000. The sales of $750,000 is needed to earn the target profit of $100,000. How did we come up with this $750,000, you might be asking? Well, what we did is we took our fixed cost plus our target profit divided by a contribution margin ratio. The first step you've got to do in order to figure out how many sales dollars you need to sell in order to make $100,000 of profit is you first figure out your contribution margin ratio. To do that, you take your unit contribution margin of $30 divided by the selling price. Tells us our unit contribution margin ratio is 40%. Then we figure out our sales dollars. To figure out how much we need to earn in sales dollars to earn $100,000 worth of profit is we take our fixed cost plus our target profit. That's $200,000 plus $100,000 divided by our contribution margin ratio of 40%. So $300,000 divided by 40% equals total sales dollars that we need to sell to earn a profit of $100,000 is $750,000. Good? Makes sense? Hope so. Okay. Here's a chart. I'm going to show you what it looks graphically. Cost, volume, profit chart shows you sales, costs, and they're related. In order to construct a chart, there's a couple of steps you need to take. I'm not too worried about this. That's why we're going to breeze through this. It's just like plotting and stuff like that. Fun stuff. Here's your data. Fixed cost 100,000, unit selling price $50, variable cost 30, gives you unit contribution of 20. Remember, sales price minus variable cost equals contribution margin. Here's how it looks graphically. Now we see that we need to sell 5,000 units to get a total sales and costs of $250,000 in order to break even for this particular product. Remember, the break-even point is where your sales equals your total cost. Sales equals total cost equals your break-even point. Okay, we're almost there. This is a revised. So in the revised situation, we reduced our total fixed cost by 20,000 somehow, whatever. So therefore, your break-even point is going to be lower. You need to sell 4,000 units at 200,000 in order to break even in this revised. We can even show you with charts for profit volume in terms of a chart. Here are the steps you need to take in order to make this chart. In this example, we have fixed cost 100,000, selling price 50, variable cost 30, gets you unit contribution at 20. Remember, selling price minus variable costs equals contribution margin. The maximum operating loss equals the fixed cost of 100,000. Sales minus variable cost equals contribution margin minus your fixed cost equals your operating profit. Your fixed cost and your operating profit are the same. At that point, we have a volume profit break even. 5,000 units you need to sell in order to break even. For your target profit, you need to sell 8,000 units. I think we're almost done. Just kind of graph, charts, things like that. Okay, quick considerations. Sales mix. For those of you who have already taken a marketing course, you know that sales mix make up the different products that you sell at different prices. That's your sales mix. Given your sales mix, you probably learned that in Intro to Business as well. Given your sales mix tells you based off of the different products that you sell, how much of each product you need to sell to break even. In this example, this company has two different products it sells, product A, product B, at different sales price, different variable costs, and at different contribution margins. They sell at different rates, and their sales mix have different percentages. The way you get the sales mix percentage is you take the number of units sold divided by the total units sold. So, in other words, in product A, I sold 8,000 units of product A out of a total of 10,000 units. How did I get 10,000 units? Product A units sold plus product B units sold. That's 10,000 units. 8,000 units divided by a total of 10,000 units is 80%. 8,000 divided by 10,000 is 80%. 2,000 divided by 10,000 is 20%. That's how I got my sales mix percentages. Here's how it looks graphically. I sold 80% product A, 20% product B. Remember, it should always equal 100%. Always equal 100%. For break even, think of the products and their overall enterprise. Obviously, I want to keep selling product A. I want to sell more of product A. I could probably raise the price of product A. If I introduce a new product, in this case, product E, I can figure out product E based off a combination of A and B. There's a lot of different ways you can do it. Remember, anytime we're looking at break even, take your total fixed cost divided by unit contribution margin to get your break even for numbers units you need to sell. And here's how it looks from a nice graphical perspective. Oh, another important ratio, operating leverage. Operating leverage. Operating leverage is the relationship between a company's contribution margin and the income from operations. We measure this by operating leverage. To figure out operating leverage, we take the contribution margin divided by the income from operations. That gives us operating leverage. Contribution margin divided by income from operations gives us operating leverage. The reason why operating leverage is important is I can look at my company, compare it to another company, and determine who has the better leverage. Who has the better leverage? The leverage, the biggest determination of leverage, of course, comes from fixed cost. Fixed cost. As you might think, the lower the fixed cost, the better. From this perspective, Wilson has a better operating leverage. Let's see, percent change in income from operations. In order to get percent change from income from operations, you'll get percent change in sales times the operating leverage. To get your percent change in sales, we take the, let's see here, where am I at? To get percent change in sales, you take your new minus old divided by old. That gives you your percent change in sales. In this example, it's 40,000, we'll say, right? The increase was by 10%. You take your percent change in sales, 10%, times the operating leverage to give you your percent change in income from operations. Again, it's not something that we're going to be doing much of, so that's why I'm kind of going through it a little quicker. Comparing the two companies side by side also tells us the percent changes, right? When it comes to operating leverage, you can compare it based off the changes in percentages. Okay, I think this is one of the last important pieces. That's okay, I understand. But thank you. I appreciate it. Margin of safety. Margin of safety is another important concept. This indicates the possible decrease in sales that may occur before operating loss is a result. So think of your margin of safety is that buffer, right? How low can I go before I start losing, right? Margin of safety. To calculate margin of safety, you can do it in terms of sales dollars, units of sales, and percent. You take your sales minus your sales at break-even point to get sales dollars. For the units, you take your sales minus your sales at break-even point divided by unit selling price. And then for percentage, you take your sales minus sales at break-even point divided by sales. That gives you your percentage. And this just kind of shows you from an example perspective. That's margin of safety. And we are done with chapter 19. We still have chapter 20 to do. I'm going to breeze through that in about a half an hour. For those of you who need to drop off early, I totally understand. I know some of you have another class coming up. And so, feel free if you need to. Otherwise, hold tight. And thank you for watching this episode of Accounting 202.